there already. So I just chat,
Oh, yep,
hello. Did you see the chat message? I just put hello.
yep,
Yeah.
everyone. So we'll wait just a few more minutes. Oh, yep, I just saw it. Perfect. Let's see. Let me know when you see my
Interesting.
face pop up. Oh, I think
Yeah,
it's
your face
about to go.
pop up. But you said where we will mute it means uh, in the
It,
YouTube.
if you want to mute yourself, Sanjay, just go ahead and
Yeah.
click the mute button on Zoom, and that'll
Okay.
work. Yep. Hello, everyone. Welcome to the IBD Meetup. I'm your host, Richard Moglen, here with Sanjay helping me out. And today we're really excited to have you guys all here, and we'll be talking about kind of trading lessons I've learned from the U.S. Investing Championships, from the U.S. Investing Champions I've interviewed, as well as other top traders and investors. To start things off, let me know if you can hear me down below in the chat. Just let me know, give me some feedback, and let me know if you can see my screen clearly. I'll go ahead and make sure that's muted, and we'll get started in just a second once I get confirmation that you guys can hear me okay. This volume is really low. Thank you, Bob. I'll go ahead and boost that up. And let me know if that is okay. Volume is low. Okay, I think I just fixed it. So let me know if that's good. But to kick things off, this is a really interesting presentation. If you know me, you know that I do a lot of interviews on my channel, interviewing some top traders: Stan Weinstein, Mark Minervini, Tom Basso, Oliver Kell, the U.S. Investing Champion of last year, Leif, Ross Haber, who I now work with over at Traderlion, as well as these other top traders. And I think this has really cut down my learning curve quite a bit. I've learned an incredible amount. And it's like anything. It's like sports. If you want to be a great trader, go ahead and interview if you want to be a great athlete, go ahead and interview the best sports athletes of basketball, football, whatever the sport you want to learn. Go ahead and learn from the best. So here is something that I made that I think is actually quite cool. It's kind of a time frame graph where I've put some of the people who I've interviewed on here. Tomas overall all the way on the right hand side, probably the fastest time frame here. Obviously does a lot of intraday trading, and as it goes, you can see Stan Weinstein and Kathy Donnelly over here on the left hand side. But there's a few people in here. I didn't include obviously everybody who I've interviewed, and Oliver, you could argue, is a little bit to the left of Leif. But in general, I think this is an interesting graph. And if you kind of want to watch my interviews, try to match your time frame to the person you want to learn from. So if you really want to learn intraday trading, go ahead and watch my interview with Tomas or Mark Minervini. A lot of quick swing trading. Even Oliver and Leif, they're very quick. But if you want the longer term time frames, Ross, Ropel, Kathy Donnelly, Stan Weinstein, those are great people to learn from as well.
Maxine Davis calls. She's available till 7 p.m. Call from to examine.
I believe I hear Anish actually. So let me go ahead and mute him quickly. There we go. Sorry about that. And we'll keep on going. So as I said, I see a lot of parallels between sports and trading. You want to study the greats. If you want to become the best baseball player, go ahead and study Juan Soto. Obviously, that's my favorite player as a fan of the Nationals. And let me go ahead and close this diagram here. And you want to break down what makes them successful. If you really want to focus on getting better at hitting, look at the fundamentals. What does their swing look like? How do they hold their bat? How do they analyze pitches? All of that comes into play. And it's not just their techniques and their skills. You want to look at their routines, their habits, how they put in the hard work. What do they do in terms of mental and physical reps to prepare themselves for each and every game? This is so important. And this preparation and mindset, I think, is something that's very overlooked by especially newer traders. And it's one of the key things that I've learned now doing this for a few years and having a bit more seat time under my belt. And as I said, I think trading is exactly the same. You want to focus on routines, habits, breaking down what the top traders are doing, and just trying to repeat that. If you want to be an Olympian, train like an Olympian. If you want to be Mark Minervini, trade like Mark Minervini. And as I just kind of said, train like a champion to trade like a champion. You want to study the best of the best. Here I've got a image of Nicholas Starvis. You may know him, the author of How I Made $2 Million in the Stock Market, a top trader, definitely a recommended book as well. And I'll have a list later on in the presentation. But he did a lot of hard work. He traded overseas, not even getting charts. He had to draw them for himself, and he actually traded by Telegram. So if he can do it way back when, we 100% can be as successful as he was using TradingView and all the incredible tools we have today. And in terms of education, I think that the pieces are really out there, a lot of them on the Traderlion channel, which you should go ahead and subscribe to if you want to see great content. My channel as well, there's great courses out there. We just put out leadership blueprints, Oliver Kell's course, Matt Caruso's course as well. The pieces are out there often for free, like the conference that we held earlier this year. And you basically want to take all those pieces and do the work, take notes, and develop your own system from all the excellent material out there, taking books, seminars, and videos. And I think what's really important, especially when you want to develop your own system, is you basically want to focus inward. Is you're not competing with the trader next to you. You're really competing with yourself, and you're competing with yourself from one day, 1 month, or 1 year ago. And the only goal you should have is to be a little bit better each and every day, so that when you look back at yourself as a trader 1 year ago, you're vastly improved, you're more disciplined, your setups are more precise, your execution is a lot better, and that's all you want to do. You don't want to compare yourself to somebody on Twitter who's up 300, 400%, because that doesn't matter to you. That's not going to affect your performance. What's going to affect you is being a little bit better than the trader you were 1 month ago. And a big step to that is basically you want to go ahead and conduct post-analysis. So post-analysis, if you're not familiar with what that is, it's basically when you go back and study your trades over the past year, past month, and basically really analyze your biggest winners, your biggest losers, and try to find common characteristics in the stocks that were successful, and also look at your weaknesses as a trader and try to identify those and basically take note of them so in the future you can do just a little bit better. And as I say here, nothing matters unless you commit to learning regardless of a strategy. You really need that passion, especially for trading, because it's such a difficult business where there's a lot of losses, you lose money, but you have to have that passion and commit to learning and improving before you're going to really make any headway. Sanjay, I just want to pause here to see if there's any questions in the chat before we get going with the rest of the slides.
It's all good now. Go ahead, please.
Okay.
Thank you.
Sounds good. So getting into lesson one, trading takes patience and hard work. And here I've got an image of course, William O'Neill, the founder of Investors Business Daily, the author of How to Make Money in Stocks here. And basically going back to the interviews that I've done, every one of the top traders who are competing in the championship, they all struggled for years before really finding their footing. And often mentors took them under their wing and kind of steered them in the right direction. But regardless, they often struggled for a long time before finally learning more about risk management, learning about their own style and themselves, so they could kind of turn that corner and really achieve super performance. So even Leif, Oliver Kell, all of them had the same difficulties that you're going through right now if you are struggling. And you just have to work your way through it and try to be a little bit better. And gradually over the years, you'll get that experience, get that seat time, and do a little bit better. I see a question here. Richard, when's the David Ryan interview dropping? I'm actually working on exporting that right now. That's another interview that we're posting to this channel, the Traderlion channel. And basically, we're having some exporting issues. It's taking a long time, but we'll try to get that out basically as soon as possible. So getting back into the presentation, to achieve better results, all these top traders studied some of the best other traders in history like O'Neill, Darvis, Livermore, and then focused on one specific style and time frame. I think this is really key. You're not going to be the best day trader. You're not going to be the best long-term investor. You have to pick one area and focus on that with blinders on and just kind of master that time frame, master one setup like the earnings gap up, the pullback to the 50-day. Go through history, study a bunch of different charts, and try to become as aware of the pitfalls of that setup, as well as how to really nail down nice gains from that particular setup, so you can master that and it becomes a source of income for you in the markets. And they basically made their style their own. And even if they were kind of influenced by O'Neill, Minervini, Darvis, Livermore, they kind of became their own trader by finding what works for them, for their time frame, their personal risk tolerance and time frame. And yeah, I see Nick, Stock Tricks with Nick in the chat here. Markets reward specialization, 100%. You don't have to be the best pullback buyer or the best breakout buyer. You don't have to be the best day trader or investor. Just focus on one and excel at that as much as you can, and that will reward you immensely. And as I say here, many of these investors put in the hard work, read similar books: Darvis, O'Neill, Livermore, Mark Douglas, Minervini. You don't need to reinvent the wheel because a lot of the stuff that we see in the market has already happened. You just have to learn really how to master yourself and find what works for you, and focus on that. So here's a little bit more about trading. Takes patience and hard work. As I said, you have to do your due diligence, read these books: How to Make Money in Stocks by William O'Neill, How I Made $2 Million in the Stock Market by Nicholas Darvis, How to Trade in Stocks by Jesse Livermore, and Reminiscences of a Stock Market Operator by Edwin Lefebvre. Those are some recommended books here. And I'll probably, once this video is up and archived, which it is, this will be recorded and archived on this channel, I'll put these titles in the description so you guys can easily go ahead, copy and paste that over to Amazon and find what you're looking for. So also, I think there's a lot of, as I said, material out there already. Videos, webinars, there's some on this channel. Mark Minervini has a great channel. IBD has a great channel. You could go to my channel as well. And there's so much material out there that you really just have to commit, as I said, and take the time to take notes. And gradually, if you just watch those videos week after week, you'll slowly get kind of additional experience passed on by those great traders. And lastly, I've got this in bold because I think it's so important, especially as you're first starting out. You basically want to write trading rules. And I kind of want to just throw it over to the chat for a little bit here. Let me know down in the chat. Give me a thumbs up if you've got trading rules that are written down and that you've basically committed to paper. And I just kind of want to see what the responses are. And then we'll also ask whether you don't have trading rules. I see actually Tomas in the chat, 100% Market Wizards by Jack Schwager. Definitely go ahead and check that out. But I just want to see the response to see how many people have a written set of trading rules. Just give me a yes or no, actually. Awesome. Cool to see a bunch of yeses. If you do not, I highly recommend going out and thinking about how you're going to react to different market conditions, how you're going to differentiate between a trending market, a choppy market, and how you're going to trade within those different conditions. And you also want to identify the setups you're going to use, the entries, position sizing, risk management, how you're going to organize stop losses. Think about this all in advance. So when it comes time to actually execute, all you have to do is look up your rules, refer to them, and then just kind of follow your rules, follow your plan. And obviously, as you get more experienced, you can kind of move away a little bit from your rules because you have more intuition, more experience, and just kind of go with the flow. But that basis in trading rules, I think, is so important. I would highly recommend before you trade coming up with a list of rules. Moving on. Lesson 2, I think this is incredibly important. You want to stay positive, stay focused, and stay disciplined. Here I've got a picture of Jim Ropel, who's you can't watch an interview with Jim Ropel and not be just kind of inspired to keep on learning, and he has an incredible passion for the markets that really comes off whenever you speak. So I always strive to be like Jim, stay positive, even if you're dealing with basically a day like today where probably a bunch of you got stopped out of things, a lot of stocks showed some distribution. You got to focus on the long term because it pays to be a bull over the long term. Just look at the trend of the market over the past 50 years. You'll see that over the long term, it goes up. So you want to stay positive and be bullish over the long term. And I think a big key to this is you want to treat setbacks as learning moments. And as I mentioned, you want to focus on incremental improvement, being a little bit better than you were one day ago, 1 month ago, 1 year ago, and take every mistake that you make, write it down, and try to learn from it. I know I got caught last year in some gap downs with Fastly, and I made some rules to kind of make sure I'm not too heavy in an extended name like it was last year. And I did execute well. I sold pretty much right at the open, but you always want to look back at those big events, those big losses, and think about what you could do better next time, because it's going to happen next time. You're going to face gap downs. You're going to get stopped out. It's all about kind of learning from those experiences. Now, as I mentioned before, you want to stick to one strategy and become a master at that particular method/setup. If you're a day trader, focus on that time frame. Focus on a pullback to the anchor VWAP, a moving average intraday, and focus and study 1,000 charts with just that setup, so you know exactly the template that you're looking for, and you can take that with you into future setups. As I said before, you want to commit to learning. That's so important. You have to be passionate for this and want to improve before any progress will be made. And judge your trading based on whether you executed your plan, not whether you made money or lost money on a trade. I think this is really important. And definitely as your first beginning, you think if you bought a stock and went up, you did something right, but that's not necessarily the case. You could have just gotten lucky that one time and you bought it extended, it paid off. But for the majority of the times, if you buy a stock extended away from a proper base or consolidation, you're going to pay the price with a quick stop loss hit. So look back on your trades when you're doing post analysis, and don't think about whether you made money or lost money. Think about whether you identified a proper setup, executed that buy point correctly, managed your risk correctly, and whether that paid off or not, because over the long run, that's what's going to build your edge. So I'm just waiting to see if there's any questions here. I don't see any just yet. Really cool to see Tomas in the chat. Good to see you, man. Hope you're doing well. And yeah, let's keep on going. Unless Sanjay, do you have any questions about lesson 1 or 2 that I've gone over so far?
No, I'm good. I see that most of the people are like kind of chatting something their subject, but nothing about the lesson. Please continue.
Perfect. So here's a little bit more about lesson 2, staying positive and staying focused and staying disciplined. I think it's important to take some time each day to reflect about how things went. If today you were flustered, think about how you can stay calm and objective the next time something like today happens. And make sure, kind of think back and think about how well you followed your weekend and daily routine. I think Anish is back here. Sorry. I'm going to mute him. Unless, Anish, do you have something you wanted to add?
On this stuff, on lesson 2?
Yeah, you just unmuted yourself. So, do you have anything that you want to add?
Oh, no, I was letting you finish, then I'll add.
Perfect. Yeah, so in terms of your daily and weekend routines, this is really what sets you up for success. So I think it's so important to do it every weekend, find those setups, know your risk, know your entries, know your position sizing before that morning bell even rings, or in the pre-market if that's when you do most of your work. Plan out those entries ahead of time, and also after the close, go ahead, study the trades you made that day, think about what you could have done better, and also what you did well. Kind of reinforce positive things that you did, and also think about the weaknesses and stuff you still need to address. And also, I think it's important to try to avoid the noise as much as possible. I know probably most people here are on Twitter. I am as well. But really, when I'm making my buy decisions, I'm not taking into account any inputs from Twitter. I'm not buying a stock just because somebody with 100K followers mentioned it. It has to follow my plan. And if it's not in my actual stocks I set out before the market opens for that particular day, I'm not going to trade it. So I think try to avoid the noise as much as possible. And Andrew, I see a question here about typical steps for post-analysis. That's at a later lesson. Anish, did you have something you wanted to add?
Yeah, so I want to add on the Twitter. I know a lot of beginner traders coming in. Do control the noise on Twitter. Twitter's an idea generation list. You get the ideas. Take a note. Don't just trade on what Richard says. And you don't ever see me talking about any trades because there's a reason for that. But when Richard gives an idea, that's an idea generation list. I mean, I use that list. I was short on time this weekend. I used Richard's list. And I was great. Let me do some research really quick on it and have a game plan. It's not a buy or a sell. It's you have to control that noise. One of the strategies I would say is don't be on Twitter at 9:30 in the morning.
Yeah.
And the market opens. Give yourself half an hour break. Just focus. Stay focused in the morning. Look at what's happening, and use these ideas. I mean, I've gotten some ideas from Twitter. From the Traderlion channels, their tweets. I've gotten ideas, but those are research. I research those stocks, look for setups, look for pivot points, and then go from there. Just don't randomly buy stuff. That should never be. That's not a strategy. That's a recipe for disaster at that point. But it's a great idea generation list. So, Kevin, great slides, Richard. Great slides.
Awesome. Yeah. Just to add to that, like make every trade your own. If you see Ben Pattern Profits post a screen and there's a name that looks good for you, do your whole process. Think about the setup. Does it fit your system? Is it something you usually do? And make it your own and manage risk as much as possible. So lesson 3, this is something I see with every one of the top traders I interview. Stay in tune with your own trading. And Anish made a great presentation on this, which I'll talk about just on the next slide. But it's really important to keep a journal, a mental picture of how recent trades have performed. Think about your last 4 or 5 trades. Have you gotten stopped out a lot, or have those done really well and made you some profits very quickly? That's kind of feedback that you can take into your trading and basically determine how aggressive or defensive you want to be in the markets. If you're trading well, press on the gas a little bit more. But if you see things getting hit and you're getting a lot of stops, slow down a little bit, size down, and we'll talk about that a little bit more on the next slide. So yeah, just take the market feedback into account. Practice progressive exposure to trade your largest when you're trading your best, and the smallest when you're trading your worst. Minervini says this all the time, and it's really true. If you've got multiple failed breakouts, stop trades in a row, scale back, and take the time to reevaluate. Is the market right? Are you right? Are you following your routines? Are you setting yourself up for success? If not, slow down and kind of take that time to reset everything and wait until conditions or yourself are right to press the gas once again. If pilot trades are working after a correction, slowly increase exposure by financing your risk. And once again, you are never forced to trade, so you can wait for those prime setups and only kind of take the trades that are high probability setups. And to follow up on that, I think Anish made this amazing art of position sizing video. I learned a ton from this presentation. I think it's linked. It's on this channel. I'll go ahead and put the link basically after I record this video. But if somebody wants to go find it, go ahead and post that link in the chat so other people can find it as well. But basically, it's all about progressive exposure, scaling up when things are working, and scaling back when things are not. So moving on to lesson 4, focus only on high potential stocks. So I kind of determine high potential stocks kind of 2 different ways. There's just the superior relative strength stocks, or there's the superior relative strength stocks that also have the earnings, the sales that we call true market leaders. Ideally, the stocks you are trading have both of these characteristics. They're outperforming the market and they have a fantastic story. Their annual EPS estimates are off the charts. Last quarter, they had 999% EPS growth. Sales were off the charts as well. So ideally, everything comes together, both the technicals and fundamentals, and those are often the best liquid leaders that I find and that I make the most money on. I think Tesla was one of my biggest winners last year. That's a great example of a stock that had both the amazing price action as well as the story with the EVs exploding, and also the earnings and sales matching everything and following everything up. So in addition to the earnings and sales, you want to see significant signs of accumulation in the chart. An early stage base is preferred, like the IPO base or first constructive consolidation after a strong uptrend. You want to look for leading stocks and leading groups, so it helps the probabilities of the trade working if not only is that stock doing well, but the entire industry is kind of following along with the tailwinds of some type of theme, like semiconductors are strong. EVs last year were a great example. Solar last year was a great example. And then you look for the leaders, for instance, in solar, SEDG, ENPH, Sunrun, RUN were great last year because they had the great numbers, as well as the overall industry move was strong, just kind of boosting everything. I think William O'Neill, from his research, said that basically 50% of a stock's performance can be contributed to the strength of the industry group and also the overall sector. So this is really important to identify the leaders within overall strong groups. And as I said, you want to look for that explosive sales growth, earnings growth as well. That adds to your conviction. And also, I always like to see increasing fund ownership as well as really strong annual EPS estimates. And also, you should make sure that the long-term trend of the price of the stock should be increasing. Is it over the 200-day moving average? Is that 200-day moving average increasing? You can basically use the Mark Minervini trend template to satisfy this condition. And here is a quick chart of Tesla. It's a little bit blurry here, but just overall over here, you can see earnings are super strong, and also the price trend was above a increasing 200-day moving average, and there were a bunch of nice buy points to get in before it really exploded on high volume. And here's just a few screens that I thought would be good to include to help you guys focus on high potential stocks. And this is more taking into account the true market leader aspect of it with great earnings, sales margins. Over here on the left, we've got the fund ownership screen, 50-day moving average greater than 20,000 in terms of dollar volume. So just trying to get rid of those too illiquid names that aren't really worth focusing on. RS rating over 80, funds percent increase greater than 15%. This is key here. The greatest stocks are going to go on huge runs because they have an amazing story with great earnings and sales, but that price increase is going to be created by the accumulation of funds and long-term holders. So this is kind of what I'm looking for with this screen. Overall number of funds over 10 and composite rating over 85. Obviously, you can take the screen, change any of the criteria and make it work for you. Moving on to earnings growth, this is another screen that I like to use. Earnings growth last quarter greater than 50%. The estimates for for the current year greater than 25%, and for the next year after that greater than 25% as well. This is going to get you a lot of those really strong names like AMD, Nvidia, which are growing very consistently, and the analysts have great projections for it as well. And you want the overall RS rating to be above 80 once again, and for it to be at least a little bit liquid. Moving on to sales growth, this is to catch the ones that might not be profitable just yet, but they still have a lot of potential, like AFRM, for instance. We've got the 50-day average volume, once again, greater than 20,000 here to make sure it's liquid, RS rating greater than 80, and sales percent change last quarter greater than 40%. And these are not hard and fast criteria. Any of these rules, you can make this 30%, you can make this 70%. It's really based on how many stocks you want to go through on the weekend. And these are just a few ideas of filters that you can use to find high potential stocks. Sanjay or Anish, anything to add about kind of trying to find those true market leaders, and any screens that you guys like to use as well?
These very screens, I was actually about to tweet about this. This is excellent. I mean, look at that. On the fund ownership, you're only seeing 20 stocks in the end. And the earnings growth, you're seeing 36. So that's already getting a very good window. Concentrate, on these stocks. You don't have to worry about the other 9,000 stocks. I mean, you're going to have the leaders in these groups, including the sales growth. To be honest, I run screens just like these, the Blue Dot RS, IBD 85 index. I do check that out. The only list that they don't have is on the paper is the sector leaders list.
Yeah, that's
really
great.
Like that. That's actually a phenomenal, but that's only in the newspaper.
Yeah.
But that's a great list. And then I go through the Growth 250, Minervini trend templates. I'm just going over those all the time. But starting point, what you just showed, these are just phenomenal. Like, it's simple. You want it to be simple. You don't want it to be too complex.
Yeah.
And this works, which you just showed.
Absolutely. And if you're making a screen that has 10 criteria, you're trying to narrow it down a little bit too much. Keep it a little bit open so you just kind of go through the charts. Because if the chart doesn't look good, I'm not going to take a trade. So you want to see stocks, and that also kind of gives you a sense of the market too. So I would say don't try to get too focused, but do narrow it down to the best of the best stocks.
And let me add, so when a person runs these screens, if you don't find setups, it's telling you something in the market. It's
exactly.
Just things are not ready. You just gotta wait it out. So like a few weeks ago, I was seeing so many setups, or weren't you too, right, Richard? Like, they're all like lining up.
Yeah.
And that was it. Like, that's all that's all you have to do. This is great. I was gonna tweet this right now.
Yeah, go ahead, take a screenshot if you guys want.
What about you, Sanjay? Sanjay, anything you want to add, since you're trading too a lot?
Yes, I see that one question Larry is asking, do you have an IPO screen for MarketSmith? I think this covers everything, right?
Yeah, it would be great also to run an IPO screen, because there's a lot of potential in those, especially at the first IPO base. I kind of use an Excel screener that I download the data from MarketSmith, so it's a little bit discombobulated. But yeah, I'll whip up an IPO screen so you can get the IPOs from the past 2 years, because often there's a lot of great winners in those stocks, even if out of that first IPO base or after that first long-term primary base is what Mark Minervini calls it, or the institutional due diligence phase if you've read the life cycle trade. So yeah, great question.
And Bob is asking, how many stocks do you look at during the course of a weekend, having trouble with too many stocks to look at? Bob is lazy, so he's asking that.
Yep. Yeah, I typically look at about 400, 500 or so. That, like Anish said, if there's a lot of setups within that amount of stocks, I know that things are kind of shaping up in the market. If stocks a lot of them are extended, that gives me some information as well to be a little bit more defensive. So I think looking at a decent number of stocks can be really, really helpful. But obviously you want to establish a weekend routine that you can knock out in 2 hours, hour and a half, so it doesn't kind of bog down your weekend. But yeah, find a medium between looking at a lot of stocks and also not too many as well. And I also saw a question from Bob earlier. Will the slides be available with the recording? Yeah, after this is done, I'll go ahead and upload these to Google Drive and drop a link in the description of this video. Let's see. Any more questions? Do you care about how new is the IPO? Great question. So IPOs that are very new, like they've just had 20 or so trading days, are playable, but kind of my mentality there is I'm renting, I'm not owning, I'm not trying to play it for a huge move, but often you can get a very nice entry up the right hand side of an IPO base and get a 20, 30, 40, 50% move. If it's a year like last year with PLTR Corsair, you can get 100, 200% out of that IPO base. But often with IPOs, they move very quickly. They've got IPO lockup, so there's a little bit more volatility and risk there. And really when I want to be really trying to hold something for the long term, I'm waiting for that first long-term consolidation, kind of what Roblox is going through right now, a Unity software, what's another, Snowflake, all these names that have had that initial run and now have consolidated and given time for the institutions to research them and potentially start building positions. That's often another really nice opportunity up the right-hand side of that first primary base. Look for a VCP, look for a first stage base, that type of thing. Let's see. Yep, I think that answers most of the questions that I see right here. So we'll carry on to lesson number 5. So I think pretty much all of the top traders, all the U.S. investing champions that I've interviewed use charts to identify setups and to time their trades. And basically what they're looking for as we've gone through charts is they're looking for standout relative strength and also institutional footprint, signs that institutions are accumulating that stock. And as a trader, you're trying to leverage both time and money. So we're trying to buy at a point where a large directional positive move is expected. It's not guaranteed, but it could be expected. So we're buying as it's breaking out of a base. We're buying as it's undercutting and reclaiming support. We're buying at a point where either we get a large directional move to the upside and we're at a profit right away, or we're stopped out with a very small loss compared to the potential gain that we have. So I say that, I basically just said this. You want to enter at a point where a large directional move is expected, and you can know exactly the point where the setup fails, and that should be where your stop loss is set. The goal is to be in a profit immediately, or basically to be stopped out very quickly, ideally that same day, and just take that small loss and basically keep those losses as small as possible so you can enter and try a stock multiple times. And as I said before, you want to master a repeatable setup. So there's basically setups that occur again and again based on supply and demand and accumulation by funds and long-term holders, like first stage bases, high tight flags, IPO bases. We'll get into a few others, but earnings gap ups. There's all these repeatable setups that if you go ahead and study, look at 100, 200 examples from the past, you can master and make that a source of income in the markets. Looking at some questions, there's a question from Ashwin. How do I identify fake setups? Do have the distinct characteristics? Sometimes there'll be flaws within the base, for instance, but there's a lot of setups that look perfect, but just don't end up working. And that's why you should always have a stop loss. You're never married to a stock or a setup. and you're very quick to take a small loss. So it prevents you from taking a small loss. If it works, that's great. But if it doesn't work, you're fine too. You're taking a small loss, moving on to the next setup or opportunity. And here I say chart reading can help traders and investors of any time frame, as I believe even if you're a longer term holder, just look at a weekly chart instead of a daily or even an intraday. You can basically help determine what the trend is on your time frame and find a spot where it's low risk to get in, where you know quickly whether the trend is going to continue or if it's going to reverse and break those key moving averages. And as Brian Shannon likes to say, only price pays, and that's why it's so important to use charts to basically help yourself identify setups and also time your trades. Even if it's an amazing stock and opportunity, it doesn't mean that it's always going to be set up for a powerful move. A company can be amazing, but we could be going through a correction. So you have to wait until the time is right, because only price pays at the end of the day. And here I wanted to go through a little bit more about why to use charts. Basically, you can use them to analyze supply and demand. You want to look for institutional footprints and signs of accumulation, like huge volume bars to the upside. You can clearly define both stop loss area and profit taking area, so you can define your risk reward. And you can analyze the trend on different time frames. Are you trading with the wind at your back, or are you fighting the market, which isn't really going to work out most of the time? For a quote here, I think is really good from Tom Basso. The closer you can get your indicators to that which is creating your profits and creating the risk, the more you can control things and run a tighter ship. I think that's 100% true. So lesson 5, to move on a little bit more, we've got some examples here of some high potential setups that I think are good to study and good to make your own, and basically they repeat over and over again every market cycle. And here's a list right here: earnings gap ups, IPO base breakouts, early stage base breakouts, and high type flag setups. Not all of these are going to be happening at the same time, but often if a lot of IPOs are setting up like right now, this IPO based breakout can be a really good way to extract alpha from the market. So the first one I want to go out to analyze is the earnings gap up. So this is when we've got a news catalyst like an earnings report, and we see enormous volume to the upside and a gap up of 10, 15, 20, even 30% on very high volume with a strong closing range greater than 50%. And with this is basically an example of Tesla in 2019 before a really outstanding run and climax run before the 2020 correction. But for this one, it was a special case because not only did we get huge volume and a great closing range on the first day, but that second day we got basically equal volume, both of which were the greatest in the past 250 days. And this really is a sign that institutions are involved, because normal traders like me or Sanjay, we're not buying millions of shares. We're buying 100 shares, 1,000 shares max. So when you see volume like this, that suggests that institutions have kind of changed their mind about the stock, that news catalyst, the earnings report, something about the guidance, something about new products, new developments has changed the institution's mind. And they basically determined that this stock is going higher in the long run. And they're just kind of slowly accumulating stock, and they're starting their positions on their first day. And because they're just starting their positions here, they can't buy and establish their position all in one day because of the massive amounts of shares they're buying. So they have to basically accumulate slowly as the stock pulls back. And this is kind of what creates the trends we see in the markets, where every time the stock pulls back, we see support as institutions slowly add to their positions and build them out over the course of weeks and months. And from here, Tesla had some nice opportunities. You had a pullback to 21 EMA, a breakout through this resistance point, and just rode that 10 EMA here to higher prices before a climax top, and ultimately breaking through key moving averages, changing character a little bit, getting kind of wide and loose compared to really nice and tight back in here. And obviously we know what happened here. There's the March correction, which brought down the entire market, including Tesla. And actually this stock obviously set back up and had a tremendous 2020. But once again, even if a stock is a fantastic company like Tesla, you wanted to sell your stock as it broke the trend and broke key moving averages, and then you can buy it back when it sets up once again. So here's another example with UPST to kind of have a more recent example. We had an earnings gap up on very high volume. We had fall through action on, once again, very high volume the next few days. And this started basically 100% trend, held that 10-day, ultimately set up a high type flag pivot, which since has failed today. But once again, if you're able to identify the setup ahead of time and either enter on that first day or through the close the next day and basically establish a setup that you can use to extract alpha from this type of occurrence in the market, that's what you can do really, really well over the long term, because these setups occur every single market cycle. Every single market cycle, we see earnings gap ups. Last year, we had Fastly, which started its huge run with an earnings gap up like this. Pinterest as well. This year, there haven't been quite as many, but there's still examples like UPST. So that's a more recent example of an earnings gap up. Moving on to the IPO-based breakout, here's an example with PLTR in 2020. Obviously, you're not always going to get a huge run like we did with PLTR, but this is pretty classic. We have a dry up at the bottom of the base. We have volume moving out to the upside, and basically a VCP within its IPO-based breakout. And then we have volume to the upside, the breakout. You could buy earlier within the base right here maybe, or through this high getting a little bit earlier, but the standard pivot is right at that high of the IPO base. And from here, you usually get a nice trend above the key moving averages. But once again, these IPOs are more volatile. They obviously can fail. Path kind of failed its IPO-based breakout. Everybody's watching that one. And you always have to be ready for the downside, in addition to being ready to catch the upside and ride those key moving averages to higher prices. And always have an exit strategy, especially with these IPOs, because as I mentioned, your mindset should be more about renting a stock versus owning it for the long term, because often these do end up failing and forming some type of longer term consolidation like PLTR, and they don't always just keep on going up. That's kind of unrealistic. Next up, we've got the early stage base breakout. This is actually Shopify back in 2017, I believe. It formed a nice, basically early stage base here after a nice run up the left hand side. I always want to see a nice strong uptrend before a base, and ideally this base is pretty tight. There's signs of accumulation, big volume to the upside, small volume to the downside, and you can see it really tightened up here. You could have entered a little bit early in a kind of a VCP type breakout right at this point, and then you've got the standard base breakout, which once again led to a really nice trend. So there's another example of an early stage base breakout soon after the stock emerges from a proper base, or basically after that first institutional due diligence phase. This is often a really good spot to get in, and you want to see volume on the breakout, volume slowly taper off within the base from left to right, and basically want to see all those winning characteristics and positive price and volume characteristics as well. Moving on, we've got the last of the repeatable setups that appear over and over again within the market. This is digital turbine apps from last year, and a lot of people found out about it near 50, near 100. But if you were watching this carefully, and actually I think Leif, this is from my interview with Leif, he was on this high tight flag that set up right after it came out of a long-term base. So if you want an early stage base, this is kind of the first breakout through this high right here, this resistance level. You could have caught it here, but it also set up another potential entry, a high tight flag setup getting really tight against the 21 EMA. Look at the dry up in volume here, and then the explosion in volume before another earnings gap up. So there's kind of a bunch of setups coming together here. You've probably got another earnings gap up here, breakout of a first stage base, and then a high tight flag, another move up, and then another earnings gap up, starting a really nice run in 2020. So I know I just went over a lot in terms of setups. I want to know if there's any questions in the chat or any feedback or things you'd like to add, Anish or Sanjay.
I love the your scripts, Traderlion scripts that you guys have done. It's part of my workflow now with the green bars showing up. That's such an amazing clue. And you can look at that in this start of apps.
Yeah.
Before it broke out, look at that volume just coming in, and the price, contraction is right there, but the volume is, the buying power is coming in.
Are you talking about right over here, or in the high tight flag breakout?
The top with a diagonal trend line breakout.
Yeah. It gets super tight. Volume completely dries up. No supply is coming to market. And Leif, in my interview with him, who's the U.S. Investing Champion in 2019, if you don't know him, he talks about the reverse pocket pivot, where you see the lowest volume in the past 50 days, and you often get something like that right before a really strong push up, and that's a sign that supply has stopped coming to market. And if just a little bit of demand comes in, like we saw here with the volume, the stock can really push up dramatically, and that's what we want. As I said, that directional move, or we get stopped out with a small loss.
Yeah, that's a trade that that's a trade you would place when you have a game plan. That's going to happen at 9:30 in the morning. You're going to see that move. It's you got like maybe
what, 20 minutes max, 15 minutes to get in that position. But if you do your game work on the weekends, that's probably, I believe it happened on a Monday. That's definitely looks like a Monday move.
Yeah.
But that's a really, like, your scripts really highlighted. I love that about your scripts.
Yes.
So.
And Anish was talking about the green bars. So any of these green bars means that the volume on that day was greater than any down volume of the past 10 days. And that's what's called a pocket pivot from Gil Morales. And it really helps focus on the institutional buying within a base, and also the breakout volume you want to see definitely high, just like this with apps. All right, let's see. There's a question here. How do we access the TL scripts? If you go to the Traderlion website, and it might even be in the description of this video, you can go ahead and in the tools option, you can click that, and TL scripts, we've got them for TradingView, Thinkorswim, and also TC2000. That's the ones that I write, and they're completely free, and you can use them. And we've got moving average ones, volume indicators. A lot of them for TradingView are really the more kind of specced out and have a lot of features. And Norman asks, how do you look for institutional footprints? Well, going back one slide, basically these high volume up bars, these gap ups on huge volume, that's what I'm talking about when I say institutional footprints. Institutions can't hide their buying here. They're trying to establish positions, and that's what's going to lead to huge price increases down the line. When we see the highest volume in the past 250 days, something has changed about that particular stock in terms of its story, the products it's bringing out, and it's changed the minds of institutions and made them decide to start positions. All right, so moving on to lesson 6, just checking how much time I've got here. Manage risk tightly and use stop losses. And once again, go ahead and check out Anish's video. This is really that's much more detailed on this than what I'm going to talk about here. But basically, your stop loss should be placed where the setup fails. If you're buying a breakout from a downward trend line, and your stop loss should basically be the low of that range, the low of the week, the low of the day, and that way you know if it reverses at max, you're stopped out at that point where the setup has failed. Probably if you see a stock squatting, you're selling half, managing your risk a little bit more tightly. But you always want to place your stop loss where the setup has failed. And you want to use basically your position sizing to limit your equity losses per position to small fractions of your account, for instance, 0.5% to 1%. And if you cannot manage your risk, don't take the trade. I'm going to say that again. If you cannot manage your risk, don't take the trade. If a stock is already up 7-8%, you missed it on that day. Too bad. There'll be plenty of opportunities the next day, the next week, the next month. Don't feel like you've ever missed out on something, because there's always opportunities every single day in the stock market. And as I say here, no FOMO allowed. I had a graphic up earlier on a previous slide. You don't want to succumb to fear of missing out. In the market, there's opportunities, as I said, every single day, every market cycle, and you just have to prepare yourself to basically capitalize on those opportunities. And if you miss something, there's always something else down the road. And per position, the best traders I've interviewed usually keep their stop losses on their positions under 5%, some 2-3%, even 1%. So keep that in mind. The standard O'Neill is about 7-8%. I like to keep mine a lot tighter, usually about 3.5%, 3% or so. Sanjay and Anish, I'm curious. So what do you guys like to keep your stops at?
My stop is usually very tight. I'm at this stage I do less than 3% max.
Yeah.
But I'm gonna add something with the FOMO. I'm gonna add something with the FOMO.
Yeah.
If anyone makes like if you're trading, if you make a spreadsheet of your one's trades and you write which trades were FOMO and you take that out, I guarantee the performance will be really spectacular.
Yeah, absolutely. I agree. You never want to take a trade you're not ready for. You haven't determined how much size you're putting on, how much risk you're taking on. Otherwise, you're not being a professional trader. You're being an amateur, just following along with somebody on Twitter or something. And in the long run, you want to have a process. You want to be a professional with this. You want to treat this like a business. And real money is at stake. So you want to do as much preparation as you can beforehand, before even entering and buying any shares.
I think Sanjay was about to say something.
Yeah, go ahead.
No, I said that I try my best to stay under 5%.
Yeah.
Thank you.
Yeah, absolutely. And also, you want to go back and look at your statistics. So you want to cut your losses at a fraction of your average gain, ideally doing a better than 2-to-1, 3-to-1 risk reward, basically ratio. This kind of builds in a lot of failure. So when the choppy markets come back again and you're getting stopped out more, you're not really running into any trouble. You're not really losing money because your edge is built into your risk reward ratio versus just being right all the time, if that makes sense. I see a question here. What order should we put buy stop orders? Sometimes we are not aware what time it's breaking out. So basically, if you're working full time, you could put it buy stop that morning in pre-market if you see it's moving on volume. But basically, I don't put in buy stop orders. I like to buy the position myself after looking at the chart. So that's kind of how I handle things. I don't see any other questions here. So moving on to lesson number 7, all the top traders who I've interviewed establish routines and practice very strict discipline. And I've got a graphic here. Discipline is the bridge between goals and accomplishment. I don't know who Jim Rohn is, but I really like this quote here. And I think it's so true. And part of that is establishing a weekly routine and daily routine that sets you up for success during the week. So it's all about executing your plan when that bell rings. So in your weekly routine, you want to do market analysis. Are the conditions right for me to be pressing on the gas? Have I been trading well? All that is feedback that should kind of prepare you for how you're going to handle the next week. Then you want to build out a focus list, focus on the best of the best setups, the true market leaders, the relative strength leaders, outline your entries, your risk, your position sizing, everything beforehand. So all you have to do is press the buy button when that setup actually comes to fruition during the trading week. Then as a daily routine, you want to practice situational awareness in the morning, visualization of how your positions could perform. If a stock you're watching breaks out, how are you going to react? If a stock that you own breaks down, like probably a lot of people had today, think about how you'll react beforehand. So in the moment, you're not going to freeze up. You know exactly what you're going to do, and all you have to do is execute. During the trading day, you should not really be trying to find setups unless you're a day trader and just kind of playing volume. Instead, it should be all about executing the plan that you made the night before, the weekend before. As I said, it's all about execution when that bell rings. You can set alerts just before the key pivot points and then go ahead and execute. And at the end of the day, review your trades. Did you execute your plan properly? I think I've said execute about 15 times the past minute or so. But yeah, review your trades and pick the top setups for the next day. So once again, you're ready and prepared.
And let me talk.
Yeah.
Let me say about Jim Rohn. Jim Rohn he passed away a few years ago. He's the mentor's mentor. So he mentored Tony Robbins, and that's how Tony Robbins, he was his mentor.
Gotcha.
So he's he has a big influence in my trading performance and a lot of other areas of life. I give credit to Jim Rohn. He's the man. And Mark Minervini also knows about him. So if you guys check out his material is great.
Any books that people should check out?
Yeah, his is actually, he did amazing seminars on success.com. They have like a complete package of his video seminars. They're really phenomenal. I would credit a big part of my success in my trading performance to Jim Rohn's thinking. Like I got a lot of his ideas incorporated in my daily life. Jim Rohn definitely plays a very big role. I love his stuff. His material is really good. They have some audio CDs on success.com about Jim Rohn, and they also have the video. There's quite a bit of material that they have. It's packaged really well. So take a look at that stuff if anyone's wants to take a look at it.
Well, there you go. I'll check that out. I just like the quote, so that's interesting. Cool. All right, so moving on to lesson 8: sell systematically and objectively. This is definitely, for me at least, the hardest part of trading. It's kind of easy to look at VCPs, pivots, if you've been doing this for a little bit here, but deciding when to sell, either sell into strength or weakness, that's really the toughest part. But what's most important is you want to follow your rules and stick to the plan that you set out ahead of time. And to do this, you want to go back to that post analysis, think about where your average gain is. And that kind of should inform you about whether you should be taking profits at this point. Think about what your batting average is. Have you been trading well? If you haven't been and you get your average gain, maybe you want to take half off to kind of guarantee a profit or guarantee that average gain, and just kind of take all those factors into account and decide whether you want to sell into strength a little bit, or if the market is just coming off a correction like last year where things are going to be trending for a while and maybe not even breaking their 50-day until they're done. Think about holding a little bit longer and waiting for the stock to really break down below key moving averages before selling. So there's a little bit of situational awareness there. How far extended are we in a market cycle, or are we just coming out off a fall through day and new leaders are breaking out of first stage bases? And basically you want to ride the trend until it breaks expectations. And a great way to do that is using moving averages. I like the 21 EMA, 50 SMA. Basically, a rule of thumb for me is 2 closes below the 21 EMA. I'm most likely out of a position. I'm not really one to hold through a base, but if you are, you can use the 50 SMA, the 65 EMA, even the 200 SMA to manage your positions. I know people who have been holding Tesla since 2019, and they've just been holding that 200-day, and it's never really broken down through that. And it's basically breaking down to all-time highs once again right now. So there's many ways to manage positions based on your time frame, personal risk tolerance, personal preference, all of that. But my personal kind of way to go is two closes below the 21 EMA or the 50 SMA, depending on my profit and the situation, and I'll be out. And as I said, I don't really like to sit through bases. There's a question here about only price pays. So volume obviously helps confirm price moves, and it's important. But at the end of the day, you buy a share at a certain amount and you sell it at another certain amount, and your profit or loss is dependent on the price. So something can break out and volume can come in later, and it can still be a very successful trade. So basically, all I'm saying is follow the price trend. That at the end of the day is really what matters. Lesson number 9: concentrate into positions. So basically all the traders who I've interviewed who have really had super performance and incredible returns, they're concentrating into a select few names and trying to focus on those names and play them as much as possible. So basically a lot of them use 4 to 10 positions. That's kind of a rule of thumb. And you basically want to size positions so that they will move the needle, but also you want to avoid the risk of ruin. So unless you're William O'Neill, you're not going to put all your capital and even margin in one name and just ride it throughout its entire move. But most likely you're spreading your capital out to 4 to 10 positions. So when a stock doubles, it's going to really move things in the right direction for you. But also if a stock gaps out on earnings, you're not getting hit too hard in a way that you can't recover from. So there's kind of a balance here between concentrating into just a few positions and getting that performance boost when the market is good, but also being aware that you have to manage risk using stop losses. And if things turn against you and you're very concentrated in just 5 names, that can turn things sour pretty quickly. So you always have to be aware of that and managing risk accordingly. Also, some benefits of focusing and concentrating on a few positions, it allows you to manage things properly. You can learn how each stock trades, the character, the price action. Does it like to gap down, then finish strong? Does it break out cleanly, or does it like to squat for a few days and then break out? You can learn these things by watching a stock trade day after day, week after week, month after month. And this way, if you concentrate into positions, just a few strong trades can basically make your year. If you get 3 stocks at double and you have basically 5 stocks, you basically got an outstanding return, even if your other stocks don't do anything. So that's why it can move the needle so well. But on the flip side, as I mentioned, you have to manage risk tightly and make sure you're getting stopped out under 5%, under 3% even. So if you've got a 25% position and you get stopped out, you're mentally and financially able to move on to the next position and take advantage of future opportunities. So you always want to avoid the risk of ruin by putting too much too fast into one position before getting rewarded for that risk. Lesson number 10, as we touched on a little bit earlier, you want to conduct post-analysis and try to identify your weaknesses. And this is as true for investing as trading. It's going to be a little bit different. It's going to be more about your research process. What did you do right? But as a trader, you want to basically analyze your numbers, calculate your batting average, your average gain, average loss, Look at the best winners you had. What setups did you buy those from? Look at your worst performers. Why were you taking these losses? And you basically want to study your game film. Do exactly what athletes do after a bad game, a great game. Try to analyze those common characteristics, your weaknesses, as well as your strengths, and adjust accordingly. And as I said, you want to ask yourself what went right, what went wrong. Did you follow and execute your plan? And think about that in terms of feedback versus whether you just made money in this name. It's more about, did you follow your process, and what can you tweak your process to get just a little bit better every single day. What were the common aspects of your best trades, your worst trades? What are your statistics? Are you cutting losses properly? What can you improve on? What rules and routines can you create to do so? It's all about incremental improvement. I've got a little bit more here. This is kind of the homework for everybody watching. You want to look at your last 100 trades, calculate your batting average, average gain, average loss, average holding periods for wins, average holding periods for losses, and look at what your average gain to average loss ratio is and try to analyze those common mistakes. So I think that's pretty much the presentation I had. But Anish, if you want to talk about any of the slides or anything to add, or Sanjay, I'm all ears.
So let's go back to the last slide. That is, okay, the one after that.
Yep.
All right, so this is probably the best thing. Once you understand your batting average, you can start tweaking your numbers. Although I didn't realize this earlier on, even though I was trading, I had performance, but once I understood this, I was really able to do things a bit faster.
Mm-hmm.
And then in my controlling the losses, I'll give a clue. Last year in the competition, the entire year, my beta for the entire trading account was 0.27. The brokerage actually calculated it. I really had no, my account was more stable then. It was slower. The volatility in the account didn't even move. Once you understand your average loss. And then these numbers, when I met Mark on 2017, these are the numbers that was, once you understand this, it's a game changer. It truly is for any trader out there. Because it's like you go to the gym, you know what your numbers are, now you start to improve. It will show you where your weakness is. I actually know a very good trader. We do talk a lot and get bounce ideas. He notices his losses is really good, but his average gain is slightly below his average loss. So he's kind of breaking even or maybe a little bit losing money. So I just told him, you just got to push that gain just a little bit. Mm-hmm. And once you know that, you know where to work on. This is a really important topic. I would say majority traders, when they start off reading from the books, this is something a lot of people just think it's not important. This is the most important part. This right here.
I think you've said in the past that you can almost trade off your results spreadsheet, right?
Yeah, I'm right now just trading off my numbers. I'm not even bothered. If a stock goes up like 30%, that's great. I will be selling in strength. But once I know it's over, let's say over 10%, I'm already moving my stops up, being very defensive, and it's automatic. I don't even have to sit there and think. Extra is great. That's gravy. I'm literally turning off my spreadsheets now. I'm not even bothered by it, like so many other things. I just know where my loss is. And yeah, there are a lot of other traders I've met at the MTP conference. They're all doing all these numbers, and everyone's different, but everyone knows their numbers. Mm-hmm. Like Sanjay just said, he likes his average loss is 5%. That's fine, but with 5%, you can push that trade a little bit further out. You can go for 15% gain, and still you make a killing just by doing that. So I know Mark average Minorini on the MPA. Sometimes I've seen him. Some stocks he gives maybe 5%, room, but his gain is way much larger. And sometimes his average loss would be less than 1%. But once you know your numbers, you can play around it, and the goal should be your average gain should always be higher. That's given, but knowing how your batting average works, how many wins you have, how many losses you have, this is the holy grail. Understanding this, It'll transform your account. I guarantee you it. It will transform you as a trader once you understand this. Don't you agree, Richard? Like, you interviewed all these guys. You should know this way.
Yeah, for sure. And I was looking at my numbers. In early 2021, I got chopped up. Gave back pretty much the profits that I had at the beginning of the year. And I looked at my numbers, and my batting average was lower than last year. My average gain was lower than last year. And I knew from that point I had to be a little bit more selective with setups, try not to get as chopped up, and also take profits a little bit quicker and cut my losses tighter. And that's kind of the adjustments that I made, and that did pay off and allow me to do a little bit better than I was doing.
Yeah, because earlier in the year it was very choppy, and that's when when Mark was talking, and like he was telling, wow, like the markets stocks would rally and fail the next day, or fail within 15 minutes.
Right.
So something was going on. So in that sense, your exits had to be faster. Like just like these numbers will give you feedback. It's like a feedback mechanism. Like you just said, like you got that feedback. I have to change my tactics a little bit differently, and then you did, and then it works. These numbers, I mean, we could do like so many presentations just on this slide here, but this is where magic happens, is understanding these numbers. So
yeah, and here's a picture of Kobe studying game film. So if it's good enough for Kobe, it's good enough for you. So that's it.
Yeah, Kobe would do that. That's you're right. He would study all his games, and that's he would if Kobe's doing it, I would do it.
That's the mentality of a winner. There's always something that you can be better at,
So Richard, a couple of questions here. One is, could you explain more 21 EMA 2 clauses?
Sure. Let me go back to a chart here here's NEO. So for me, kind of the 21 EMA is my guide. So from my buy, I bought it on the breakout, the VCP breakout here. And had a position throughout this. And basically my sell usually is on 2 closes below the 21. So here it breaks out, gets above the 21 EMA. Here the 21 EMA crosses above my cost. And when we've got a powerful market like we had in 2020, and all the QE, all the cash coming in, stocks that are trending like this are going to trend for a long time. And often the 21 EMA, if you look back in history, study winners, the 21 EMA will catch the majority of that first strong move. And then often when it breaks that, it starts to build out a base, which NEO did. And you can use the 50-day, you can use the 50-day here, get a little bit longer here. But the point is, I'm using the 2 closes below the 21 EMA as kind of my indication that the trend has changed a little bit. It's breaking expectations. It's no longer finding support the moving average and confirming up. It's changing character, and I don't want to really be involved in the stock through a base building process that kind of takes away my time. As I said, I want to leverage both time and capital. So that's kind of why I use the 21 EMA, but there's fantastic traders who use the 200 SMA, the 10 EMA. It's based on personal preference and your own time frame.
So the 2 closes means the 2 bar after 21 EMA, or?
Yeah. So when the stock first closes below this line, that's the first close. Then the next day, if it does it again, that's the second close.
Okay.
Yep.
Okay. I think that answer. Adam is asking if by chance one of the stock gaps down like 7-8%, do you immediately sell the very next day, or what?
If it's below my stop, I'm looking to sell in the first 15 minutes. I might give it a little bit of time to see if it has a snapback rally. 8% is pretty steep. So I'll probably blow it out if it doesn't immediately change character. Yeah.
And he's also asking, you would sell if it is a new purchase or you don't have profit cushion. Means like, suppose you did something with a great setup and just it fell right next day. How you will react?
Yeah. So with this example of NEO, if this didn't break out and instead it turned around and failed, like some breakouts do, I'm out if it hits my stop, no questions asked. And I'll take that small loss. And if it sets up again, I might try it again or just move on to another stock entirely. So my sell rules are, if it hits my stop, I'm out. Or if it breaks, once it's in a trend, I've got some profits. Once it changes character with a moving average break, that's usually where I'm selling into weakness. And if it went up 30% in 2 days, I might sell into strength here and look to add those shares back and trade around the position, which is a little bit more advanced when it sets back up with a kind of secondary buy point when it gets tight against the moving average once again.
Okay. The last question here is that, are you putting same dollar amount in each trade, or you are risking the same dollar amount like your risk to reward on each trade?
Yeah, great question. It's not always the same dollar amount. It kind of depends on the setup, the quality of the stock that I think, the quality of the setup, how many edges I have. I look at the base. If there's huge signs of accumulation, like here with NEO, you had all these gap ups on huge volume of the left-hand side, then a pretty tight base with a really nice drop in volume. So my edge was apparent right at this level. So here I sized up a little bit more. But if it's a little bit more volatile stock, or the setup's not quite as clean, I might not put as much of my money in that stock. Or if the market conditions are a little bit iffy, that's again a reason why I might size down a little bit.
Let me add to that. If you're starting off, like, let's say from fresh tomorrow, you shouldn't size up at all. There's no cushion. You should plan. Your portfolio should be planned. As you have cushion, you can, then, there's an art to it when you're sizing up. You kind of know this chart is going to be, this explosive move is about to happen. You'll see it. The apps example with Richard marked, that was the type of trade, perfect. Before that breakout happens, you would see that volume contraction happening. And let's say you have cushion in the account. That's the type of trade I would go very explosive on literally on that breakout within that first 15 minutes, because your risk to your probability, you know where your stop is. You plan ahead. If it's within range, you can go really explosive on a move like that. But you have to plan. You have to, let's say I'm starting from scratch and I see a move like that tomorrow. I will not size it up because I don't have any cushion in the account. Because that's how you control FOMO. If there was FOMO, you would be buying it left and right, and then your odds actually go to 50-50 because it would work or it could not work. Chances are it's going to 80%, it will fail at that time, just because that's how market works, right? Like, just because you think it's a great thing, it doesn't work that way. You have to have a game plan. To size up on a trade like this, you have to have some previous trades which build up on the cushion, because it also reflects there's a lot of psychology behind all of this to take a move. I saw a trade that totally blew my mind. I saw Mark Nervini do a massive trade. His stop was 0.5%, but the size was huge. He did 4x leverage for that trade and sold it in 15 minutes. I still, this day, I'm like, wow, I want to be as fast like that. But you don't get there till you have some cushion. You've got to, there's an art to it, and you have to have all these things coincide. Like in this app example is the perfect, with the volume at the bottom of the chart. There's so many things coming in together. That's the type of trade you have to be. So the reason that stock moved up is a lot of heavy institutions were ready to jump on it at the same time, and that's where you have trades like that. That's where size can make a difference. How you plan yourself, and it that's a little bit of experience. Will just plan your day out, and that's how you'll get to it. I hope that helps you, Richard, on that answer.
Yeah. No, for sure. I think that's pretty much all I wanted to cover in the presentation. But if anybody has any questions in the chat, just drop them in. I'll try to answer them if I can. And just going back to Anish's video, I think this is really this will probably answer a lot of the questions with progressive exposure. So I highly recommend checking this video out. This was really an amazing presentation.
Yeah, I copy paste that link in the chat room if anyone interested.
Perfect. Perfect. Thank you.
I have to say, Richard, these slides are mind blowing. I mean, this is like just a very amazing, like a cliff note. Just understand these rules, and I mean, this is really good slides.
Thanks.
This is the right stuff in these slides. I mean, understanding these slides, all including the screeners that you showed. Oh, you'll get some really good performance
I'd
From the
like,
screener, Anish, I have a question to you and Richard.
yeah.
In MarketSmith, when I see the chart pattern recognition, which is really helping me in my journey, is that way that this screener, we can add one like a technical screener which will catch all the cup and handle or consolidations? Like, do they have some algorithm like that? Have you ever
I
tested it
think
or?
they do. I
Yeah.
think they do.
I think you can look at the near pivot in under the MarketSmith 250. I don't know if you can scan by all the cup and handles in the market or something like that, but I think they have something
Okay.
similar. Anish, do you know?
I think it's the near pivot one is the one that would
Okay.
come in my mind. I think that would be the one. They have a screener. It says on there we should either put a screenshot of that or pull it up. It's called, yeah, as Richard said, it's near pivot.
Yeah, I'll bring up MarketSmith right now on my other screen.
Yeah, we should just go through that.
Here we go. So let's see.
Also, Mark Minervinis put another one, 1 to 4 months. That
Yeah.
also giving me good.
I discovered that a few days ago. That was like, wow. The 1 to 4 months is my sweet spot zone.
Yes, me too.
That's a really. I was surprised they didn't even announce it, and I was like, wait, they added something new.
So I know Sanjay and Anish, you can't see this, but you can go to where I did in MarketSmith, look at Growth 250 pattern rec, and look at breaking out today, recent breakouts, near pivot, tight areas, power from pivot.
Yep.
Yeah, if you look under the reports, you'll be able to find it.
Okay.
Yeah, that's the one. That's the one. Those are the ones. Yeah, after the market closes, playing around MarketSmith for research, that's what I do on the weekends. I don't really research during market hours. It's just, that's not advisable. I mean, unless you're not trading, that's a different story. But I like to, use these screeners. There's a lot of stuff just by these 3 simple screens, but you'll get some really good, it's a very good net.
Yeah.
I'm just looking at how it's, these are the numbers that even I look at, RS rating 80. If you bring the RS rating to like maybe 70 and onwards and see the stocks which change from 70 to 80 as they're turning, those are really good setups.
Right.
Those stocks are going to be really, really good. But yeah, these screens alone are amazing. I would say. Yeah, I mean, you did the work, Richard.
Thanks. And like Anish said, you can play around with these, change them, find what works for you, and you can even do the 3-month RS rating and see how that works versus the 12-month. So there's so many ways you can screen. You just got to find a routine, stick with it, and if you missed a really amazing stock that everybody's talking about on Twitter, look at your process. Why did you miss it? Kind of take that as feedback. What can you do next time to catch a stock of similar quality? Did it have amazing earnings, but you didn't have an earnings list, earnings screen? All those things make a difference over the long run. You just have to take that feedback and be ready for the next one, if that makes sense.
Yeah. There's a train every day.
Yep.
I know there was a question about that stock that everyone was talking about this whole week, DWAC. Well, it's apparently down 50% from the high from yesterday, so I can't trade that stock.
Yeah.
I got some messages on it, like there's no way I would have seen that stock on my radar. It just, wow, But wait for a setup. All these stocks will give setups,
Mm-hmm.
That's good. There's volume there. Now I'm going to just see if a stock pattern forms and trade off that. That's the way I would handle DWAC. Was there another one, Richard? Another stock like that which blew up yesterday?
Well, there's PHUN Fun. Did you see that one?
I didn't get to see that one. I know there was BKKT.
BKKT, yes, yeah. I think that has some fundamentals behind it. I think something crypto related. Yeah.
Yeah, that's crypto related. Something happened. Some news thing happened. And that thing just took off. So I'm just gonna wait for a setup on it. That's just all I can do.
Right. If a stock's gonna be a long-term winner, it's gonna have so many setups that you can trade. You just have to wait and be patient.
And that's how Oliver trades, right? He will trade set up on his strong trade. Like he'll just get in and out. Like I saw him how he did Tesla last year. He traded that so many times.
Yeah.
So yeah, there's no shortage of setups. You just have to wait. Yeah, that's about it on my end.
Yeah, I don't see any other questions. I guess we'll just kind of call it there, unless Sanjay, you have anything else like?
No, I think we are good, and it's dinner time. Thank you very much for.
And Sanjay's presenting next month.
Yes, I'll put a date and the subject in Meetup later this month. Thank you.
Perfect. Well,
thank you, Richard. This was excellent slides. Wow, this is truly a work of art. I would print these slides out. Just go over this material. Check out the chapters and the books, which tie in with these. This is such a good slides. Great job, Richard. Great job.
Thank you. To everybody watching, I hope you guys enjoyed. Thanks for all the kind messages in the chat. Make sure to go ahead and subscribe to the Traderlion channel and leave a like on this video. And it'll be archived, and you can watch it as many times as you want if you missed something or want to go back. And I'll go ahead and get those slides and put them in the description as well. So with that, I'll go ahead and end the live stream. Everybody take care. Have a great rest of your day. Thanks.